Welcome back to part 2 of day trading terms and lingo that you need to know. If you've missed part 1, link is in the description below, go and watch it after this. In this video, I'll be covering the essential day trading terms related to the technical aspects of trading, condensed and to the point, so stick around to the end. Let's begin. Risk to reward ratio, or R for short. When you take a trade, you put on risk. You expose yourself to the possibility of both taking a loss as well as making a profit. So ideally, you should know exactly when you will exit for a loss, and that is considered as a unit of risk, also known as R. For the long scenario on the left, we see that our reward is denoted by the blue shaded area, which is 3 times larger than our risk shaded pink. This means that the risk to reward ratio of this trade is 3, or 3R. For the short scenario on the right, the amount that we stand to lose if the trade doesn't work is the same as the amount that we stand to gain if it does. This is a 1R trade setup. For those of you interested in foreign exchange trading or forex, you will come across PIP plenty of times. This stands for price interest point. It is the smallest unit of measurement for a currency pair. So there are generally 4 decimal places for foreign exchange pairs, and the 4th decimal place is considered a PIP. So in this example, we have the euro versus the US dollar. We see the price is listed as 1.1562. The smallest unit of measurement is the 4th decimal place, which in this case is 2. So if the market increases to 1.1568 from 1.1562, the market is considered to have moved higher by 6 pips. Not all currency pairs have a pip being the 4th decimal place though. So for Japanese yen pairs, a pip is the 2nd decimal place. So in this case, we have USD versus the JPY. And if it went from 114.02 to 114.52, the market is considered to have increased by 50 pips. Technical and fundamental analysis. Technical analysis is based on the historical price charts. There are 1001 ways people do their technical analysis. Fundamental analysis, on the other hand, is based on the overall macro or microeconomic factors, essential health of a company, and much more. Basically, it's not using the price charts that the way technical analysts do. Candlestick price charts are a way of visualizing price data. The highs and the lows of each candlestick mark the high and the low of the period. The open and close prices are marked by the high and the low of the candle body. Candlestick bodies are usually colored to show whether the closing price was higher or lower than the open. So in this case, when the closing price is higher than the open price, the candlestick is colored green. It is a bullish candlestick. On the other hand, for a bearish candlestick, our closing price is lower than the opening price, and this is colored red. Support and resistance. Support is an area in price where the market tends to move up from or fail to break below. We see a support level marked by the green line here, and whenever price tried to break below it, it was met with buying back up. Resistance, on the other hand, is just flipped. It's an area in price where the market tends to move down from or fail to break higher. This area of price is marked by the red line here, with the market failing to break above it and rejected back down. Supply and demand. I'm sure you've heard of this term before, and for those of you who had some economics lessons, you would be familiar with the supply and demand graph. Explained simply, the relationship between supply and demand is the greater the demand, if demand exceeds supply, price will be bid up as buyers try to outbid each other to obtain the item. So for example, an auction house, we have many people competing for a single item. Conversely, the greater the supply, if supply exceeds demand, price will drop lower as sellers try to outprice each other to clear their inventory. When you hear supply and demand in trading, most of the time these are referred to trading areas in the context of technical analysis. Now this is important. Supply and demand zones refer to areas in price from which quick and large changes in price started from. Taking a look at some examples, we have a demand example here. Looking at the chart from the left to right, the most eye-catching move up is this one, where price moved up strongly and quickly. We then mark the area of consolidation just before the impulsive move up, which is this green rectangle. This is our area of demand. We then extend this line to the future. Some traders use this area as an area of interest to potentially trade from in the future. So later in time, we see that the market returned back to the area, found support and headed back up. Here's a supply example using the same chart as before. This time we look for strong and fast move down in price. The clearest section is this one. We then mark the area of price just before the strong selling. This area is a supply zone where supply overwhelms demand and price drops lower. We see that the market later returned to the supply zone before dropping lower. Hey, you know what else is lower? The like button. You know what to do with it. Smash it if you enjoyed the content thus far. A frequent term you will hear is price action. This refers to the movement of a product's price over time. Hence, Price action is basically referring to the movement of this price chart. Market structure is one of the most simple yet important concepts in my humble opinion. This term generally refers to whether the market is making higher highs and higher lows, or it's making lower highs and lower lows. From this, we can deduce whether the market is trending up when it's making higher highs and higher lows, or trending down. If the market is neither trending up nor down, then it is ranging, where price is kept within a range for a period of time. A moving average is one of the most popular chart indicators. This indicator calculates the rolling average as new market information comes in and plots the average on the chart. Here we have a number sequence. If we were to calculate a 3-period moving average, we first start from the third number from the left, since we need a minimum of 3 numbers for a 3-period moving average. We take the average of this number and the previous 2 numbers, which is 4 plus 3 plus 2, which gives us 9. We then take 9 divided by 3 to give us a value of 3. We move one step forward, and now we take the average of 3, 4 and 3, which gives us 3.33. And we keep on going. Moving average data is usually plotted onto the chart as lines. Some of the more popular moving averages used by traders are the 20, the 50, and the 200 moving average. Another squiggly line you'll see on the charts is VWAP, also known as Volume Weighted Average Price. VWAP is a very popular indicator for traders who trade products with more transparent volume data, such as stocks or futures. What's the difference between VWAP and moving average, you might ask? Well, VWAP considers both the volume traded at a price, placing more weight on prices with heavier volumes, whereas a moving average only considers price, taking a simple average, treating all prices as equal. From this, we can already see that it actually makes more sense to use VWAP, since not all prices should be treated equally. Prices where many people were happy to trade at should be more representative of the average price. This explains why VWAP is one of the most important and essential indicators for trading stocks and futures. Even if you don't use it per se, most traders are aware of the location of it. The final term we have for today is volatility. This refers to the range of price movement in a certain period. The greater the range, the more volatile it is. And day traders generally love volatility, as it gives opportunities in the market and a greater chance for profit. An index that measures volatility of the S&P 500 is the VIX, or Volatility Index. We see key spikes in volatility in 2008 and more recently in 2020 during the recent coronavirus pandemic. So hey, if you've gotten some value out of this, go ahead and like this video, subscribe and turn on the bell notifications. But most importantly, head down to the comment section below right now and let me know the topics and questions that you want me to cover. I'll try my best to produce content for that. So that concludes part 2 of day trading terms that you need to know. So till next time, see you in the next video. T for trading, out.